Hello, everybody, and welcome to Leading Indicator, a show by Public.com focused on gaining insight from the world's best macro minds. I'm your host, Kinsey Grant, and we are here with you today to discuss a couple of very big macro ideas that are certainly interesting for anybody who is working on fine-tuning their investment and their portfolio. Right now, we are talking about global monetary policy impact as well as the state of the gold market, two big ones indeed. So don't forget to like, comment, and subscribe to our YouTube channel for more in-depth interviews that will help keep your portfolio on track. I'm so excited to welcome our guest today, who is going to talk to us all about Fed moves, the gold market, and so much more, I'm sure. His name is Ronald-Peter Stöferle. He is a fund manager at Incrementum. Ronnie, welcome to Public. How are you today?
Hi, Kinsey. Thanks for having me. I'm pretty well. How are you?
I'm doing well. Like I said, we have some big ones to talk about today. So I'm excited to hear a little bit of your insight and hopefully gain some good analysis for our listeners about what's going on. It's been an interesting couple of months and weeks in both the stock market investment, environments largely, and just the macro environment that we have to weather as investors and that we get to. So I'm gonna start here with a big question that I'm sure you are excited to answer, all about what this means. It's certainly a big one. But right now with its most recent meeting in September, the Fed target rate stands between about 5.25% and 5.5% after the decision to pause rate hikes in September. Major indexes, S&P 500 and the NASDAQ, are both up around 2% since the beginning of October. And that's even after September, which traditionally is not the best month for stocks. So I'm curious to know your perspective here with all of this recent data in mind, including a hotter than expected jobs report, some inflation stats. How are investors currently interpreting the Fed's policy with the larger macro environment that we're working with right now as investors? Talk to me a little bit about what the perception and what the sentiment might be from investors.
Well, I think, if we kind of summarize this year, in only a couple of months, we basically went from hard landing to soft landing and now to no landing. And it seems that now everybody is, when it comes to rates, everybody is in the higher for longer camp. I totally disagree. From my point of view, we are clearly moving into a recession, probably Q4 this year or somewhere probably in the first half of 2024. So I don't really buy into the soft landing narrative that has become quite popular recently. Kinsey, I think we shouldn't forget that, what's to summarize what's going on at the moment. Price of oil is up roughly 30% in 3 months. We're seeing significant moves in bond markets. We are seeing that real yields have basically moved up 350 basis points just in 18 months. And we're seeing that this kind of COVID sugar rush is fading out. We're seeing that, households are running out of excess savings. We're seeing that student loan payments are restarting. And I think, if we follow the track record of the Federal Reserve, just with the most recent example saying, well, inflation is contained and it's only transitory and so on. And then basically completely panicking in spring of last year and, starting one of the most aggressive rate hike campaigns of the last couple of decades. I don't really know and don't understand why, markets really believe in the analysis and the prediction that the Federal Reserve now is making. So, as I've said, I don't buy into the soft landing narrative. I think we're going to move into a recession, which is, something normal in a cycle, but therefore I think that interest rates, will trend significantly lower over the next couple of quarters.
Yeah, this higher for longer stance that the Fed has taken has certainly been, something that a lot of market experts have wondered whether or not this is going to work the way that the Fed anticipates that it might. And of course, it's an imprecise science that the Fed is trying to get to here. But I'm curious about how exactly you think the Fed might move through this potential recession that you're talking about, even as soon as Q4. You mentioned that interest rates might go lower. But I'm just curious beyond that, what do you think the Fed is prepared for or is preparing for, knowing that we have heard plenty of calls for a recession over the last year and a half or so, many of which have not come to fruition? I'm just curious if you have any insight as to what might be the tools they would deploy in addition to interest rate changes should this recession come to pass.
Well, obviously, I mean, we shouldn't forget that we see some sort of a triple tightening at the moment. It's not only very aggressive rate hikes. It's also quantitative tightening, which is often forgotten, which basically sucks out 1.1 trillion out of the market every year. And the third tightening, from my point of view, is the strength in the US dollar that we have seen recently. Now, this in combination with a global trend where basically all G7 countries are in a very late cycle, and many economies, for example, Germany, are already in recession, where China is not really coming out of this economic mess that they're currently in. I just don't see how this soft landing narrative can really survive the next couple of months. Now, what can the Federal Reserve do? Obviously, lower rates again, but I think they will be quite hesitant because obviously they have lost an enormous amount of credibility over the last couple of quarters by making this very poor inflation call and then reacting way too late. So they will try everything to kind of contain this trust that they have gained over the last couple of months, that they're actually in charge again. The second thing that they obviously can do is reverse quantitative tightening and go back to some sort of a QE environment. And I think at some point, especially having a look at bond markets, as there aren't too many marginal buyers around, I think they will come up with something like a yield curve control. Perhaps the term will be different. It will be another abbreviation that sounds very, very sophisticated, but I think it will basically be some sort of a cap on bond yields. Now, I think one more thing that is really interesting to answer is the question why we haven't moved into a recession yet. I have to tell you, we were way too early with our recession call. We didn't get it right, but I think we have clearly underestimated the enormous amount of fiscal stimulus and the time sensitivity of fiscal deficits. Basically shows that fiscal policy is fast money creation and credit tightening is slow money. So the amount of fiscal stimulus, the US is running roughly like a 9% budget deficit now in an environment where actually the economy is supposed to do really well. I didn't really see that coming, and this is kind of a paradigm shift that we have seen. One of our previous reports was called the monetary climate change, where we basically described that, COVID was basically the breaking point where politicians all around the globe realized that, well, actually, fiscal stimulus works. You can obviously stimulate the economy, you can stimulate inflation, but once the genie is out of the bottle, it's hard to get it in again. So I think that we as investors should probably focus less on what central banks are doing and saying and focus more on fiscal policy, because this has really been the driving force in markets over the last couple of quarters.
Yeah, very interesting. And I would say certainly a bit of a departure from the norm in terms of what the some of these macro minds are primarily paying attention to, which lately has been an enormous focus on the Fed. But there are a lot of other elements out there that are worth considering. To your point, we have to consider both monetary and fiscal policy. But I would also like to hear a little bit of your perspective on some of the particular asset classes that we might be paying attention to right now and moving forward, should this recession materialize or not. So one of those that I would love to talk about today is gold. You would think in most cases that gold would be an asset class of choice if investors are potentially exiting stocks and bonds. It tends to be more of a safe haven asset. But gold futures are down in the last 6 months. So talk to me a little bit about what the story is with gold as an asset class, as a potential investment, and why investors might be approaching this asset class in this particular way.
Well, first of all, I would say that gold isn't an asset class, but rather money. So I think we should not, make the mistake to always compare it to, productive assets like equities or real estate or bonds or whatever. We should compare it to currencies like the US dollar, like the euro, and so on. And if I follow, the purchasing power of gold versus the purchasing power of fiat currencies, I think gold has done a tremendous job over the last couple of years. And the role of gold is not to make you rich quickly, but rather to preserve your purchasing power over long time frames. Now, I think it's as I've said before, we should not underestimate the headwinds that gold was or is facing in regards to opportunity costs. So real yields, as I said before, have moved up by 350 basis points in just 18 months. So we've basically been, when it comes to real yields, at a 25-year low. And now went to a 20-year high in just 18 months. So this usually would suggest that gold would be trading around 15 or 1600. Now it's still trading at 1900, and the big question is why. And my view is, first of all, that the amount of physical buying from central banks, especially from emerging markets, China, Russia, but also Turkey recently. Singapore has made purchases. So I think this central bank buying is really becoming a significant driver for gold. On the other hand, we can see that when it comes to ETFs, I put out a tweet today saying that actually ETFs, which are, from my point of view, assigned for, let's say, the Western financial investor, they're basically on the sidelines. They even sold ETFs over the last couple of quarters. Now, my bullish case would be if gold continues trading well, and we've seen a huge move last week, then I think at some point FOMO will kick in, and we will see that Western financial investors will reconsider buying gold. So that's clearly the positive case. On the other hand, obviously, I think the most negative setup, let's say the worst case scenario for gold would be a soft landing, which the market is kind of discounting now. But if it should really materialize, then I think gold will go lower. But that's definitely not my assumption.
Okay, good to know. Now, Ronnie, I have one more question for you here before I let you go. You brought up some ideas about emerging markets, pressure on the dollar. I would love to combine those into a question that is certainly interesting and has been top of mind for a lot of investors lately. This idea of the impact of international monetary policy on what we're doing here in the United States is always front of mind for investors, but especially lately with the idea of some of the BRICS countries, BRICS, Brazil, Russia, India, China, South Africa, creating their own currency that could potentially challenge the US dollar. Talk to me a little bit about your perception of this BRICS currency and how it might impact investors.
Well, we've been quite clear on that topic. I mean, it was something that went kind of viral in social media over summer, and the source of this whole rumor was a tweet by the Russian embassy in Kenya. And they put out a tweet regarding the upcoming BRICS meeting that a new gold-backed BRICS currency will be issued. So, I mean, I don't trust the Russian embassy in Kenya too much. Perhaps, the intern was kind of bored and just put out a tweet. But from my point of view, I think, we are rather seeing a de-euroization than a de-dollarization at the moment. On the other hand, I think that If we have a look at what they decided at the last BRICS summit in South Africa, they will welcome 6 new members: Saudi Arabia, Argentina, Egypt, Ethiopia, Iran, and the United Arab Emirates. So from a geopolitical, a geostrategic point of view, this is pretty significant, especially as the BRICS will be responsible for more than 50% of global oil exports then. So therefore, I would say it is a trend that we're seeing. It is like the small brother that is growing up, but it's not really treated or respected well enough. But from my point of view, the casualty first will rather be the euro and not so much the US dollar.
Okay, very interesting. All right, well, we'll have to track what intern had access to Twitter on what day. Had quite the impact on global markets. Well, Ronnie, this has been wonderful. Thank you so much for sharing all of this great insight with us today. I really appreciate you joining me.
Thank you very much, Kinsey. It's been a pleasure. All the best.
Absolutely. Same to you. Thank you all for listening to this edition of Leading Indicator. And thank you to our guest, Ronnie Stöferle, the fund manager at Incrementum, for joining today. And I will see you next time. Have a good one, everybody.